Hi, my name's Steve Aldridge. I'm one of the advisors here at Fitzpatricks, and today I'm just spending some time with Alex Hone, our Chief Investment Officer. Just had a few questions for him that I thought you may be interested in the answers to. Alex, as we move into 2012, what has changed since the end of last year?
So if we turn back to 2011, Steve, one of the key things the market was focused on was their concerns around Greek default. Towards the end of the year, in December in particular, the European Central Bank committed to a new operation called the long-term refinancing operation, which really was a bit of a game changer to solve some of these issues. What this did was basically the ECB provided European banks with unlimited 3-year funding at an interest rate of 1%. Now, without the stigma or some of the limitations that were typically attached to previous programs, the banks could borrow unlimited amounts of money from the ECB both in December and then again recently at the end of February. The banks took the opportunity to borrow over $1 trillion of euros, and this has had a number of market effects on issues in Europe. And these are threefold. The first of them is it basically solved the bank funding needs. By the end of 2011, European banks were starting to become unable to fund themselves in the market, meaning that lenders to them had dried up completely. The second thing it did was it basically provided a catalyst for the ECB to monetise or to solve some of the liquidity issues that was turning into sovereign debt. And so we saw, for example, Italian 10-year bonds fall from 7% to below 5% in yield. And the final thing it's done is it's really provided for an increased potential for profitability to many of these banks through the region. So borrowing at 1% and being able to lend that out or go and buy assets such as these government bonds at 3, 4, 5% allows for these banks to make a margin. And on our estimates, the European banking system will be able to generate profits of circa 300–400 billion over a 3-year time frame on the back of this. This, together with better news coming out of the US, and the market starting to become less convinced or more positive towards a soft landing in China, means that sentiment generally in 2012 has increased compared to where we were at the end of last year.
What are you expecting for 2012?
So in terms of the year ahead, Steve, one of the key things we think will continue to occur, and that is volatility. Whilst a lot of the issues in Europe have been solved in terms of the short-term potential for contagion, we think that there are structural issues there that still need more work. It's likely that Europe are going to suffer a recession this year. In addition to that, the issues or the solutions provided to Greece so far, in our view, is just kicking the can down the road. But all these things are going to look in the context of what's going on globally. The reality is that China produces the economic equivalent of a Greece economy about every 11 weeks. So one of the things I think you'll find in Europe is that a lot of the policymakers have been focusing on trying to segregate the issues from Greece and ensure that they don't inflict pain or contagion across the rest of the region. And this again is one of the benefits of the LTR program in our view. But as well, it's important to focus on some of the good news. As I mentioned previously, the US continues to generate better economic numbers, whilst they're still not robust, and that still relies on the housing slump to ameliorate. It's still a much better circumstance in the US than it was many years ago. Similarly, China is coming through a period of high inflation, and it appears that they've successfully managing to cool the economy there without a hard landing. The final thing on China will be as they continue to reposition their economy to more a service and internally oriented economy than one that's export driven and reliant on their major trading partners.
Given an expectation that it won't be smooth sailing, why was it a good time to invest?
Well, it's a good question to ask. Given we expect there's going to be continuing volatility and these increased risks that abound in the global economy, why are we comfortable investing at the moment? Put simply, we think there are a number of very attractive opportunities that we can continue to exploit. Unfortunately, it's very easy to get overwhelmed in investment markets by the amount of negative press or negative sentiment that pervades. But one of the interesting questions that's important to ask is it far easier to invest when markets have increased 20%, or is it better to invest when markets have fallen 20%? Unfortunately, most of us want to be investing after things have increased 20% because we're far less concerned about risks. But in reality, it's the complete opposite. It's far more attractive to invest when things are already being priced in, these risks are already being priced in. And the second important element to that, Steve, is time frame. While some of these markets will continue to generate short-term volatility, what we're always trying to do is identify structural reasons why an investment will continue to generate real cash flow. Now, no one can predict what will happen over a 3, 6, 12-month time frame in terms of markets, but things that are generating real cash will, over the medium to long term, reflect in their price this real cash flow that's being generated.
I understand the Australian company reporting season has just finished. What are some of the key themes that flowed through this?
So in general, I'd say we're very pleased with the reporting season that we've recently gone through. And again, it's thrown up a number of very interesting anecdotes that have helped us as we continue to invest for clients. One of the things I'd probably point out though is the reporting season was far more positive than the news would make out. In general, the majority of companies were at or around expectations, and it's very important to differentiate as well between accounting earnings, where a company might take a write-down and have to put that through their profit and loss statement, and underlying cash flow, which is what we focus upon. The first sector which is of interest to us is the banking sector, and it's fair to say that the banking sector had subdued growth being reported. This was really driven by credit growth, as well as the highly publicised compression that they continue to face on their net interest margins, which is basically the difference between what they borrow money at and what they lend it at. Now, this has been a catalyst for them to increase out of cycle mortgage interest rates, which we've seen through January and the early parts of February. Now, ultimately, this is a positive thing for investors because it shows the pricing power banks have in ultimately being able to pass through the higher costs that they incur as a business. On another positive note, the banks have continued to wind back with impairments or bad debts. So ultimately that was something that we were looking at and keeping a watchful eye on, and it is proving slightly better than we were expecting. The second sector for us, which is very, very pleasing at the moment, and we think the market is misunderstanding, is the energy sector. At the moment, Australia has a massive, massive program of LNG development. It has about $180 billion worth of developments in the pipeline over the coming years. And Santos and Origin are two securities that we're exposed to that have an exposure in this area. But ultimately, gas prices in Australia are likely or expected to go up in the coming years. And this is ultimately as the gas that we produce locally start to become linked to gas offshore. At current prices, you pay, Origin will sell their gas in the local spot market at about $3 to $4. In Japan, that same gas will cost about $12. And these LNG projects are basically providing a link between the gas produced in Australia to this global marketplace. The final thing that's important to touch on is the continuing structural dislocation we're seeing in many of the sectors of the economy and those which we're seeking to avoid. Two come to mind, which we've talked about previously, and they remain manufacturing and retailing. Ultimately, both of these sectors face massive, massive headwinds, structural headwinds, and this is a large contribution as well from the Australian dollar, which remains at very high levels. Now, ultimately, we think that for both of these sectors and a number of others, they're ultimately going to suffer many, many years of subdued growth and development. And they're sectors that we're avoiding in their entirety because we just think that they're not going to be able to continue to compete with the offshore producers who have both lower cost bases and domestic consumers are able to access these products offshore now far more cheaply.
You mentioned the Australian dollar. What are your thoughts here?
Well, the Australian dollar has certainly been stronger than we're expecting. We've seen recently that the number of the commodities, major commodities that Australia exports have fallen in price, and this typically leads to a commensurate fall in the Australian dollar, but this in this instance hasn't been the case. For us, there are a couple of reasons why this is. First of all, the Federal Reserve in the US has a committed policy now of holding interest rates close to zero through to 2014. Now, ultimately, with Australia being one of the few economies globally with real positive interest rates, it leads to a very, very large difference in terms of the interest rate differential between Australia and these other countries. In addition to that, many of the countries, and the US is no exception to this, have been engaging in a large amount of quantitative easing, which is basically printing money. Over time, this activity leads to depreciation of those currencies, and the market's expectations are for the Federal Reserve to potentially commit to another round of quantitative easing. Now, whilst we're not as convinced that this is a likelihood, it certainly has been weighing on the currency from that respect. And the final point of it is just the strength of the Australian dollar, which is obviously a corollary to the interest rate situation. But ultimately, Australia remains one of the few Western economies with a very, very robust credit rating, strong underlying growth, and ultimately the demand for Australian assets and Australian dollar appreciation is something that we continue to expect.
Well, Alex, thank you very much for your time. I found that very informative, and hopefully listeners did as well. So should you have any further questions, please contact your advisor. Thank you.